Hello and welcome to Investment Week's Multi-Asset Outlook for 2022. I'm joined by an expert panel who will help shed some light on the year ahead. We're lucky enough to have with us today Annabelle Brody-Smith from the Association of Investment Companies, Kel Nwanaforo from Asset Intelligence, Victoria Scholar from Interactive Investor, Ben Kumar from 7IM, Klisman Marathi from Pareto Economics, and Hortense Bioy from Morningstar. Thank you all very much for joining us today and giving your time to help guide us through the year ahead. So I suppose a good place to start for everyone would be looking back on the year we've just had. You know, what have been some of the key industry themes over the last 12 months, and which of these do you expect to continue into the new year? Perhaps, Annabelle, if we start from the trust perspective.
Absolutely, yes. Thanks, James. Well, it's been a strong year for investment companies this year. The average investment company is up 15% so far. And with that, we've had record fundraising, over 14 billion raised this year, 16 new launches, but also a lot of existing companies raising money. And I think it's really interesting if we look at some of the sectors, because it's really dominated by alternative assets. Renewable energy infrastructure has really raised over 3 billion. Infrastructure, again, a big over 2 billion. And growth capital, which is late stage venture capital investing, 1.9 billion. So you can see there's real demand for those alternative assets, obviously producing a yield, but also growth capital with the investment in later stage private equity, again, high growth. And the interesting thing is, will that continue next year? Well, we'll have to see. It's going to be dependent on market sentiment. But I think it's highly unlikely that the demand for income is going away at the moment.
And Hortense, from the past 12 months and continuing into the new year, perhaps from an ESG perspective, what do you think the key themes are and will be?
Yes, I mean, this year, clearly, I mean, we saw record inflows into ESG and sustainable funds. And I think there's still going to be a lot of money flowing into this type of investment next year. So maybe I can mention a number here. At the end of September, we saw $3.9 trillion of dollars in ESG funds globally. We saw throughout the year record inflows and record numbers of funds that, ESG funds that launched, but also converted. So I'm sure this, we don't know if there's going to be more record numbers next year, but clearly the money in ESG funds will continue to be supported by investor appetite for ESG and impact investments. This appetite will be helped by more transparency and more clarity about the options that are available to investors. It will be supported as well by regulation and new industry standards. And we also have MiFID II that will come live in August next year. Just to remind you that there's an amendment to MiFID II that requires firms to provide firms that provide investment advice to consider the client's ESG preferences in addition to the financial objectives. And I think this piece of regulation has really the potential to accelerate capital flows into sustainable and ESG funds, which is one of the objectives of the EU. So a lot of drivers, which I think are going to continue to be favorable to ESG and sustainable funds. Climate also, I know this is a theme we're going to talk more in this program, but this is also something that is really top of mind for investors, and we'll see more options offered to investors to mitigate climate risk, but also to provide investors opportunities to invest in climate solutions. So that's certainly something we're going to talk about more next year.
And on that conversation of flows, Victoria, with the database and the people that you have within Interactive Investor, what do you guys see as the past year and the future year?
Yeah, I think there have been quite a few big themes over 2021, which look set to continue into 2022. The main one, of course, being inflation, which has been the biggest talking point for markets this year, with US CPI at nearly 40-year highs and UK inflation at 10-year highs. And this has been a problem that spanned far beyond UK borders, with the global supply chain essentially struggling to keep up with demand in the faster than anticipated global recovery out of COVID. And this links to the response from central banks, which are looking at the problem and deciding whether or not to raise rates, or whether the threat of Omicron means that, in fact, they need to keep rates where they are. The Bank of England came very close to raising rates last month, but in fact decided to hold off. It wanted to be data dependent. And now it looks as though rates won't be going up until next year.
So, Clissman, what do you see are the themes from this year running into next?
We have a couple of things that we've seen this year. Firstly, liquidity is at an all-time high, okay? Inflation at an all-time low. We have a very geopolitically hot climate, with not only the usual suspects really throwing their weight around, but also fledgling nations trying their best to enact their power on the world stage. Inflation has really impacted not only emerging market nations, but also more established countries. So all of these things are going to continue into 2022, and also the big C word. COVID is something which I think many people also believe, will be one of the biggest deciding factors of sentiment into 2022. None of these things are going to disappear anytime soon. So these are going to be the themes that I think, along with more long-term themes like, say, crypto and globalization, which will have their piece of the cake in the investment attention span into 2022 as well.
And from your perspective, Kel, what's particularly on the horizon?
So I think one of the key themes, or the key theme of 2021, was certainly inflation. And I think investors relearning how to position their portfolios for that. And I think, given that very much remains a live debate as we head into 2022, the kind of trends we saw last year are going to continue. So that's things like increased interest in alternative assets and real assets. Investors looking again at more cyclical funds, more value-orientated funds, which perhaps they'd lost interest in for the few years beforehand. So I think that's very much was the key theme last year, and a lot of that is going to carry through as we head into 2022 as well.
And Ben, from your perspective, what has marked 2021 and what will mark 2022?
So lots of the themes that everyone's already talked about. I think the interesting thing, or one of the interesting things, is going to be, in a world where inflation is a bit higher, in a world where interest rates are higher than they've been for the past decade, can the previous winners continue to win? The multiples on those 5 or 6 large US tech stocks, will they be able to keep them up? We know these companies aren't, in bubble territory. They all make billions of revenues, but your Googles, Facebooks, Apples, Microsofts, will investors stay as in love with them as they have been over the past 5 years? That change and that shift towards cyclicals that we just talked about, that could be really telling for lots of people who are currently still not positioned for it.
Sure. Now, crypto has been sort of the buzzword in different circles since at least 2009, since Bitcoin was created as a concept. But if we take a snapshot of the lay of the land as we see it now, okay? So what we see right now in existence currently are sort of 10,000 types of crypto coins that retail investors mostly are putting their money into, and some are seeing extraordinary returns, but the far majority are going to be duds. On the higher end of the scale, we see the Bitcoins and the Ethereums of the world having much more institutional focus for many different reasons, although the narrative of crypto isn't a homogeneous one. There are different uses for different types, which is why I think the investment community, at least the more established investment community or the smart money, is perhaps trying their best to understand it by using traditional forms of investment insights, which you can't really do with crypto, and especially the derivatives of crypto being things like NFTs and other sorts of innovations, which currently right now are tested and probably the easiest, the most lowest hanging fruit. But when it comes time to mass adoption through a sort of structural adoption in different kinds of industries, that's when I think we'll see the biggest attention paid by the biggest investors, the more institutional investors, and that's when I think we'll see the most active movement in this space into at least the next 5 years.
And Victoria, do you hold a similar view on it? I know crypto is certainly a conversation that happens a lot in the retail space.
Yeah, well, I think that clearly cryptocurrencies have got a lot of interest among retail investors over the last year. In fact, meme stocks and cryptocurrencies were among the most searched terms on Google in 2021. And this is a theme that's likely to extend into 2022 and beyond. It is getting a lot more mainstream adoption with the first Bitcoin futures ETF and with some of the Wall Street giants like Goldman Sachs setting up trading desks. So I think that we will continue to see a rise in the overall size of the crypto market. Also linked to this is the idea about the metaverse. We've heard that Facebook has now obviously changed its name to Meta, and it really does feel as though VR and AR are going to become a critical part of many tech stocks offerings. We know that Apple, for example, is entering into augmented reality as soon as 2022. It's also going to play a critical part in terms of e-commerce. IKEA, for example, is adopting this technology as a way for you to explore their products. You know, you can see what a sofa is going to look like in your living room. Also, clothes shops are likely to have the technology so that you can try something on virtually. So the world is really changing, and we're looking at a more and more digital future.
We've seen the sudden emergence of the Omicron variant over the past few months. How much bearing do you feel that COVID could have on the markets in the following year?
So unfortunately, you're right, the lesson of the past few weeks is that sadly the pandemic is very much not behind us. I think it's going to remain a key focus for investors throughout 2022 as well. And in terms of the Omicron variant, which we're all wrestling with at the moment, I think it's unlikely that we're going to see lockdowns return in wide scale across developed markets. I think appetite for those is waning. I think it's also worth noting that a lot of the support schemes that they depended on, things like furlough, have now expired. But that said, even measures like Plan B, which we've now got in the UK, do have a dampening effect on overall demand. So I think it's going to be very interesting as we go through 2022 in terms of which is going to win out. Will it be your quality defensive type companies, which you would expect to do better in that kind of environment? Or will Omicron actually cause further disruption to supply chains because of things like snap factory closures and port closures in Asia, which impacts a good supply chain? You'd expect that to have an inflationary impact, which should be better for value and cyclical stocks. I think it remains very early to call at this time. So the best thing to do from our perspective is just to make sure that your portfolio is prepared for both of those outcomes as we head into 2022.
And Ben, is this similar to your perspective on the matter?
Yeah, so we think of it a little bit differently. We think the world is perhaps overreacted to a new variant. Got a little bit complacent over the summer with how things were going with the pandemic, forgetting that even when it becomes endemic, we're still going to need to have vaccines, still going to need to have some measures in place until this becomes a really normal way of life. However, I think as we go through this, the world will start to open up again. As Kel just said, people have had enough of lockdowns. Western society isn't going to take it anymore unless there's a real risk to life. So the economic prospects for 2022, we could see a boost. We could see suddenly people realizing things aren't going to stay shut forever. Actually, things looking pretty good. China's got a handle on most of the variant suppression. Supply chains will stay intact, and a rally in cyclicals, a rally in value, and a sort of just boost of overall confidence could actually mean 2022 is better than it feels at the moment.
From perhaps an investor perspective, Victoria, what do you feel the impact of Omicron will be this year and into next?
Well, sadly, COVID continues to be one of the biggest risks to markets in 2022, with the threat of Omicron in the near term and potentially other variants looking further ahead. We had started to see stock markets decorrelate with COVID before the emergence of Omicron. But as we kind of wait to digest the severity of the latest variant, we've seen the COVID-sensitive stocks under pressure again. We've seen rate hike expectations pushed back. We've seen the pound slump to one-year lows. So with the threat of further government restrictions, travel curbs, lockdowns, the pandemic will continue to impact financial markets.
Annabelle, how do you think this impacts on the trust side of things?
Yeah, well, I think it's important how it impacts on the trust side of things and also how it impacts on investors. And of course, we can't underestimate COVID. It's still impacting our lives. People are in hospital. It's tragic. But I have to say, markets have proved resilient since the initial sell-off in March 2020. The investment company sector was up 8% in 2020. It's up 15% to today, this year. COVID hasn't got away, but I think we are adapting. I think we are learning to live with it. Here we are working from home again. And I think there will be some opportunities again with the disruptive industries, the technology, for example, the healthcare. But also, I think Ben made a very good point that the economy could come back strongly. And I think we have begun to adapt and live with it. And we welcome the opportunity to actually go out again and spend money. And if you think about this time last year when we were heading towards a complete lockdown, I think there's still some optimism from my perspective that perhaps things, of course, the reality is no one knows.
We've heard a wide range of perspectives there and various things that this may or may not impact. Clisman, do you feel that this rings true with your view of the markets and the bearing Omicron might have?
I think when COVID became a thing for at least Western investors, there was a panic in the first place. And this panic came along because when investment is disrupted by the investment community, I think there's a very clear understanding of what you can do to fix it, whether it's central bank intervention or whether it's government intervention or investors themselves reallocating to suit the situation. But when it's a healthcare scare, then that's when the investment community needs to look outside of its own walls for insights into what the future may hold. And that's what they did very, very slowly. It's all well and good having a chief investment officer giving their point of view on world affairs, but what you really need to be doing is listening to healthcare chiefs to really understand what are the fundamentals, not financial fundamentals, but healthcare fundamentals. That's a key word that I think we sometimes lose in the investment community, the fundamentals in the healthcare world, which is why investors need to be paying much more attention to healthcare experts and in building models which also, which not only tries to model financial unexpected truths, but also healthcare modeling. That's something that they can do externally, but they haven't probably done it as well as they could have, only because this is something which we haven't seen, at least in modern days, where we have such integrated and interconnected financial markets together. Coming into the new year, Omicron is probably not going to be the last sort of wave of this, also considering that the world is bigger than just the Western financial institutions, and we may see smaller waves of other strains in different parts of the world. And getting the saying, getting back to normal, it may be the case for some of us, but again, what works best in one part of the world may not be applied to other parts of the world, only because the fundamental dynamics of vaccinations and the actual healthcare risks are different. So supply chains, although we understand how we can keep them more robust, it's not to say that tomorrow we may see some more in the future, only because we don't know what this virus holds for us, only because we as investors cannot control the fundamentals like we can perhaps in other sort of financial situations.
Turning from one global topic, which may have different answers in different places, to another, sustainability, ESG, and this conversation has certainly been all across the news this year, with COP26 getting going at the end of October, beginning of November. Hortense, if we look at what happened at COP26, what lessons did we learn from it, and what's important before we get to COP27?
Yeah, I think a lot has been said about COP26. I mean, some observers have said that it was a success. Others have said that it wasn't so much of a success because in the end, all the new pledges that were made don't add up to 1.5 degrees, which is what really we need to achieve according to the science. And also a lot of opportunities were missed. For example, no progress was made on setting a global carbon price, which is deemed necessary to curb global emissions. So that was a major disappointment. Now, On the positive side, coming out of COP26, we get the sense that the world has finally recognized the urgency of the climate crisis. There was some acknowledgement of the need to win the global economy of its dependence on fossil fuels, and also some promise to end deforestation. One of the highlights was that for the first time, the finance and investment sector was, we're actively engaged in the discussions with the creation of the Glasgow Financial Alliance for Net Zero. We've got now $130 trillion committed to net zero emission targets by 2050. Now, there has been some criticism of this number, but it seems likely that all these institutions, so asset managers, banks, and insurers, will now take a more comprehensive view of climate risk across the portfolios and will commit capital to companies and projects that will help the world transition to a net zero economy. So how do we move forward? Well, clearly, until governments seriously step up to the challenge, the private sector will need to drive change, and investors have an important role to play in that. Investors need to engage corporate boards and CEOs to make sure that they understand their responsibilities, identify the risks and opportunities related to climate change, and ultimately commit to net zero by 2050. These companies, have the power to drive the necessary change, innovate, and close the ambition gap that still remains. Companies in high-emitting sectors that don't want to transition or won't do it fast enough are companies that will probably be left behind. We're hearing more and more investors, asset managers, and asset owners that say that they will divest from these businesses if through engagement they fail to convince these companies that this is the right thing to do. And they will divest not necessarily from a values perspective, but clearly from a financial perspective. So that's going to be interesting to watch. I think starting from next year, we'll hear more and more asset owners say, "Hey, we're going to divest from, for example, oil and gas producers. Coal first, and then oil and gas producers that do not have transition plans, or serious ones at least."
And Victoria, from that perspective of asset owners, investors, one, do you think they're taking the matter seriously enough? And two, do you expect this trend of sustainable and impact investing to continue to grow?
I think there's no doubt that investors are taking this theme very seriously, with COP26 creating a laser focus among investors on sustainability and sustainable investments. And I have no doubt that this is a theme that will continue into 2022 and beyond. At II, we've relaunched our ACE 40 ethical fund list. And there's a sense that there's just so much growth potential in the sector. And it doesn't have to be at the detriment of returns. Electric vehicles, for example, is a really interesting way to play the theme. We've seen really strong performance lately in Tesla, but there's room for many more automakers in the space, driven by this government shift towards electrification. We're seeing improving battery technology. And of course, we're seeing a massive rise in the percentage of electric vehicles in terms of the overall market. The last couple of years, we've seen Tesla hit some major milestones, becoming the most valuable automaker and entering the $1 trillion club after its deal with Hertz. But there are many more players out there, and there is room for a number of winners here.
And in the closed-ended market there, Annabelle, perhaps you mentioned at the beginning there's a lot more interest in renewable energy. There's perhaps different investment in the private sector. How do you feel trust investors are looking at this sustainability topic?
Well, I think they're taking it really seriously. And I also have to say, I think financial advisors are taking it really seriously. We did a survey of financial advisors. 89% of them said they expected demand for ESG investments to increase next year. So there's clearly, they think they're going to be doing more investing. In the investment company sector, renewable energy has seen huge demand. And this is solar energy or battery storage, wind farms. We've seen huge demand for that. And that is partly because it's sustainable. It's also generating a generous income for investors. And it's seen as relatively stable income, something that's not particularly volatile. So I think there are a number of strengths for the asset class, but investment company investors are taking it very seriously. The AIC this year asked all their members to disclose their ESG strategies on their website. Over 76% of those have done so. Next year, we're going to be doing best practice guidance for our members on those ESG strategies. So plenty going on.
And just stepping back to a slightly wider perspective, Clisman, how do you feel that markets, or on a more macroeconomic scale perhaps, people are viewing the sustainable investment drive?
Good question, James. And there's sort of a three-part answer to that. Firstly, on the returns that we've seen this year. Now, when you have liquidity at all-time highs and interest rates at all-time lows, everyone looks like a genius if you invest in the stock market. You don't need to do much. Although, because whether you are a retail investor or a more professional investor, institutional, these times seem very unreal compared to the fundamentals that we've seen. So that's good, but also worrying at the same time. Okay. Secondly, if we treat, this is my strong opinion, if we treat ESG as just a theme in investing, we'll never get anywhere, because that means there are alternative kinds of investing along with ESG that you should be putting your mind towards. And if climate change is such an important thing, then it should be one of the only things that we should be considering. Now, this isn't the investment world's fault, because again, in a world so filled with different kinds of worries and different focuses, ESG just becomes a theme because there's so many other things to consider. And when you look internally into the world of investing in ESG, I think there are going to be three main reasons why ESG doesn't fulfill its potential. The first thing is understanding ESG metrics. Now, this has been a thorn in the side of the investment world for a long time. How do you actually measure what you're doing? And how do you measure first of all, how do you define the benefits and how do you measure them? Because in one metric, let's say a company like Facebook could be at the top, and another metric it could be at the bottom. So understanding the metrics is something that we haven't figured out completely, perfectly yet, or even close to it. And we must be real about this. Secondly, as investors, depending on what kind of investor you are and how much you have of a specific company's stock, you're very removed from the day-to-day decision-making processes of the company. So you can't really impact so much what a company decides to do unless you come together with other investors, or unless the declaration comes out that we will divest from you if you don't do X, Y, and Z. So that's the second thing. And also thirdly, I think one of the most important things that we haven't discussed yet is that holding periods of stocks has gone down dramatically over the last 40 years or so. So if investors are willing to hold on to a stock long enough to see changes in that company, then what I won't say the word loyalty, but what impact do you think an investor could really have in the fundamental aspects of what a company is doing day to day in fulfilling its ESG objectives? And also a bonus fourth point is that when we speak about ESG, I think we're very top heavy on the E, because social and governance aren't really as discussed, and we really focus on the environmental as what we're actually talking. We say ESG, but what we're actually talking about is the E. And if we don't solve the first three problems that I spoke about, and if we consider ESG as just the theme, then there's only so much the investing world can do, and we will end up being more frustrated by the concept than the progress we make for the concept.
Turning to another large topic that certainly reared its head towards the end of the year, inflation. People have spoken about that greatly at the end of 2021. Does that continue into 2022? Ben, what's your perspective on the matter?
There's two types of inflation. Well, actually, there's only one type of inflation, but there's two worries about inflation. There's the worry that people have, and it's kind of historical. It's, will I be able to afford the things I need to get by? And if you live in the UK or the US or Germany or France, the answer is yes, you will. Food prices, fuel prices, shelter, they're a small part of our basket of spending. So if the price increases, even if it doubles, people will still have enough money to live. That's not true if you live in Ethiopia or Nigeria or Bangladesh. Food price doubling there creates debt, creates starvation. So that type of inflation, the one that gets people worried, gets people thinking about, wheelbarrows of money in the Weimar Republic or Zimbabwe, that's not a problem. Certainly not in the West, and most likely not in the emerging markets either. Not for an extended period. The kind of inflation that might be a problem for markets is central banks hitting their targets. Because let's be clear, every central bank in the world is aiming for 2% inflation, aiming for positive inflation. The minute you get up towards 2%, above 2%, interest rates start being talked about again. And we don't think that a rising interest rate environment necessarily kills growth, kills the world, but it's something that investors haven't seen for 10, 12 years now. And investors, markets, they hate change. They really hate change. Or maybe that's unfair. They love change when it's cool Tesla and its amazing electric cars and rocket ships. Love that change. They hate the kind of change that is interest rates rising and having to rework out how to price government bonds. That shift is going to be really important over the next year or so as people come to realize that although there isn't going to be hyperinflation, there is going to be some inflation. And that just shifts the ground that we've all been standing on for the last decade. So it should be interesting.
Kel, does that ring true for you?
Absolutely. I think, as Ben says, it's inflation. It's an environment that investors haven't had to prepare for really for about 30 years. So it's going to remain a big topic in 2022. And I do think we see price rises broadening out across the different basket of goods. We're certainly seeing tightness in the labour market, particularly in the US, which again is the relatively recent phenomenon. We're seeing wage rises go up in particular for lower skilled and lower paid workers, which is definitely a change compared to where we've been for the last 10 years. And I do think it's interesting that we're seeing the Fed start to look and sound a bit more worried about inflation than they have previously. And of course, they've retired that word transitory, which I think we've all gotten tired of over the past year. So there's certainly some sort of medium-term factors which are driving inflation, which make it look like it could be something to worry about. But I do think looking a bit further out, you do have to think there are still reasons to expect that inflation might come down. So we've got things like base effects in areas where we saw prices rise most sharply this year. So things like car rentals, used car prices. Those rises will gradually drop out of the figures over the months ahead. We could also see declines in energy prices. It's very uncertain which way that goes. You've got to bear in mind the big impact that variable has on the figures. And also things like shipping price indicators. We saw big rises throughout 2021, but we have now seen them start to peak and start to turn down. So I do think there is a debate about whether inflation is structurally higher from this point, or whether it is still ultimately being driven by these shorter term factors. And I do think when we look at the tightness in the labour market and those wage rises that I was speaking about, I do think there's a debate about whether we've seen people retire from the labour market. We've seen people reassess their careers. Gradually, as the savings people have built up through the pandemic are run down, they may choose to rejoin the labour force and ease some of that pressure. And of course, the ultimate release on that pressure valve is if wage rises continue to be too high for too long. Of course, that's the perfect reason for business to say, well, let's invest more of our budget in automating these roles in AI, which should dampen down those rises too. So I think it's certainly going to be a big question for 2022, but I still think if you take a very long view, some of the key factors which kept inflation low throughout the last decade, like high debt levels, like unfavorable demographics in a lot of countries, and like that technological change, they could come back into play, and they are still there in the global economy on an underlying level.
And Victoria, how do investors protect against inflation?
Yeah, well, it's an interesting one because clearly we're in an inflationary environment and clearly we're looking towards the potential for tighter monetary policy on the horizon. So it's making it a lot more difficult for investors to find real returns on their savings in the banks. And so that is, of course, encouraging investors to find returns elsewhere, such as in the stock market. And there is the sense that after the trough in March of 2020, when stocks were really beaten up over the last a year and a half ago, since then, we've seen very strong returns in the major indices stateside as well as in Europe. So investors have been able to be relatively indiscriminate in terms of their investment plans. But now we're starting to see the potential for a bit of a growth slowdown, which means that investors are going to have to be a lot more selective in terms of stock picking and choosing the right names. And alluding to what Ben was saying earlier, it's been those big tech stocks that have driven a lot of the gains, particularly in the US markets over the last year. And whether that can continue or not means how well US markets will perform. So it's all about stock picking into 2022.
And Annabelle, does that apply the same to trust investors?
Well, I think it's really interesting, this whole issue of inflation. It's the biggest cause of concern. We polled our member managers, and it's their biggest concern next year. 9 out of 10 thinks rates are going up. Second biggest concern, inflation rates going up, all linked. I have to say, I think investment companies are well positioned to deal with inflation. You have the sort of absolute return type companies like personal assets, capital gearing, rougher, which have allocation to different assets, which obviously very helpful in this respect. I also think, our dividend track record is something that matters a lot for investors looking for returns at the moment. I just looked at the average equity income investment company is growing its dividends up 6.2% per year. Got to have quite a high rate of inflation to knock that out. In addition, we have, these companies that every year increase their dividends. We have 18 dividend hero investment companies that have increased their dividend every year for over 20 years. We've got 6 of them that increase their dividend every year for over 50 years. And I think, that kind of reliability for investors who are looking for yield in this sort of environment is very important. But clearly, there are going to be winners and losers from an inflationary environment. I think investors need to really think about having, as ever, a balanced and diversified portfolio that's going to deliver for their investment needs.
To bring this to a bit of a conclusion, it might be nice to hear from each and every one of you, from your own perspectives, what is one key area to watch next year into 2022? And I think if we keep it to a sentence as much as possible, it might be a good way to really drive home these points for everyone. So perhaps, Hortense, do you want to start us off?
Yeah, this year, obviously, with COP26, we talked a lot about climate, but that's going to continue next year. Another theme that is actually linked to climate change is biodiversity and the rise of nature. I think we're going to have or hear more conversations about biodiversity because it's you can see it as natural capital as a new asset. This is something that's been undervalued for decades, and we realize now that we need to preserve our biodiversity because that can have implications for food security, jobs, and livelihoods of many millions of people across the world. So we're going to hear more and more investors really be interested in this topic in particular.
Ben, your one key area in one sentence.
I think it's Chinese equities. I think everyone's really scared because the regulator over there, or President Xi Jinping has said, lots of scary things. You shouldn't be scared of Chinese equities. It is the second largest equity market in the world. The government needs it to keep growth going. So any investor with a long enough time horizon should be increasing allocation to China rather than cutting it.
Victoria?
Well, it's essentially topics that we've been discussing throughout this programme, but I think that inflation will continue to be a theme going into 2022. Problems with the supply chain, global chip shortages, the threat of Omicron, and, of course, the potential for monetary policy normalisation.
And Kel?
Might be a divisive choice among viewers, but we think Japan looks good for the months ahead. You've got monetary policy being kept easier than in many developed markets, certainly than in the US. The new government as well is keeping its foot on the fiscal accelerator. Again, that's different to other markets where we're seeing COVID support being withdrawn. At the same time, the market looks good in terms of valuations, and it's also quite a cyclical market, which again could prove useful if inflation does remain elevated over the months ahead.
Klisman, your key area.
So I don't think you could have one key area, because if you have only one key area as an investor, you're really blindsiding yourself by focusing on one thing. So I've got 4 things for the audience for today. The first is globalization and all the factors in relation to that. Geopolitics remains in 2022. Transformative technology, like we touched on a little bit today, but a lot more in regards to that, and also societal change, so demographic change, movement of people, movement of ideas, which will impact markets too. So those 4 areas, I think, remain, continue, and will coalesce to be something which you need to keep a focus on into 2022 and beyond.
And Annabelle, to round us off.
I'm going to say regulatory announcements on basically to tie them up, open-ended funds invested in hard-to-sell or liquid assets. So open-ended property funds, we're still waiting for the FCA to make a decision on those. I really would have thought we know that by now, but they have not made a decision. So that's something we're going to have in 2022. They have made a decision on long-term asset funds. This is the structure with a minimum of 3 months notice period to invest in a liquid asset in effectively an open-ended structure. We're waiting for the first launch on that, but the FCA said they're going to consult on wider retail distribution of the long-term asset funds in the first half of next year, something that we don't think it's ready for. Quite honestly, we would like to see this run through different economic cycles before we widen it out to retail investors. And finally, no panel on investment is complete without talking about Woodford. We've seen reports today that he's apparently fundraising in the Middle East, but we're waiting for the FCA's decision on Woodford. Obviously, a lot of investors, a lot of financial advisors impacted, really very devastating collapse of Woodford. And we're waiting for a conclusion on what will happen.
Annabelle, Hortense, Kel, Klisman, Victoria and Ben, thank you very much for finding the time to talk to us today and to guide us through 2022.